Hello and welcome. Today we shall be taking a look at infrastructure products and galvanising services provider Smith Holdings PLC. The company has a market capital of £869 million and is currently ranked 195th in the UK FTSE 250 index. In the 2017 financial year, Smith had a turnover of £585 million and an operating profit before tax of £70.2 million, which gave it a margin of 12%. It currently pays an annual dividend yield of 2.68%, which is paid semi-annually in January and July. This dividend is covered 2.21 times by the earnings per share. The company was founded in 1824 by Edward Hill and Henry Smith and was known as Hill's Ironworks. After the last working proprietor with founder connections died in 1909, the firm was made into a private limited company. The current CEO, Derek Muir, joined the company in 1988 and was appointed to the board in 2006. Smith is a holding company for over 40 companies worldwide, employing over 4,400 staff in the USA, France, Norway, Sweden, India, Australia, and in the UK, which has around 46% of the employed. The group's operations are organised into three main business segments. Infrastructure road products accounted for about 30% of the group's revenue and 25% of the group's operating profit. It designs, manufactures and installs temporary and permanent road safety barriers, hostile vehicle mitigation products, street lighting columns, bridge parapets, temporary car parks, traffic management and variable road messaging solutions. The other group is infrastructure utility products, accounted for about 38% of the group's revenue and 21% of the group's operating profit. They provide industrial flooring, plastic drainage pipes, security fencing, steel and composite products for a wide range of infrastructure markets. The third group is galvanising services, which accounted for about 32% of the group's revenue and 54% of the operating profit. They offer corrosion protective coatings for a wide range of products including fencing, lighting columns, structural steelworks, bridges, agriculture and other products in the infrastructure, steel fabrication and construction markets. For the previous 4 years, Smith has had a consistent revenue of between £454 and £585 million, an operating profit margin ranging from 7.1% to 12%, which gave it an average of 9%. The forecast for 2018 is a revenue of around £627 million and a margin of 11%. Despite trading updates throughout the year indicating that the forecast will be lower than this, the board still expects full year 2018 results to be in line with current market expectations. It generated earnings for the previous 4 years of between 24.1 pence and 67.7 pence per share. The dividend has always been covered by at least 1.3 times the earnings per share. The share price standard deviation for the past 12 months was 166, compared to 917 for the FTSE 250. The current share price is 38% above the 52-week intraday low. The final results, announced the 7th of March 2018, saw a good year for Smith, with revenue up 8%, profit before tax up 15%, and earnings per share up 15%. The dividend was also increased by 14%. Net debt was reduced from £112 million to £99 million. On the 9th of May, Smith acquired the business and assets of Work Area Protection and its associated affiliates for a total cash consideration of $42 million on a debt-free, cash-free basis. It was funded from the group's existing bank facilities. The trading update on the 17th of May stated that revenue was behind 2017, but that the full-year forecast remains unchanged. The half-year results on the 8th of August saw revenue up 1% at £295.4 million, but profit before tax fell 12% to £33 million, and the earnings per share fell 13% to 28.2 pence. This fall in profit was caused by short-term project delays in UK's roads programme and being unable to pass on the volatility of zinc prices to its customers, impacting profits. International businesses continued to trade well, with a strong performance in the USA. After seeing consecutive years of growth, this update was not well received by the market and the share price fell 26% on the day. The trading update on the 22nd of November saw revenue for the period increasing by 11.5% to £224.7 million. During the Q3 period, the group completed 2 transactions for a total consideration of $18.6 million. The net debt had increased to £152.6 million, principally by acquisition spending. In October, the UK government increased its road investment programme across 2020 to 2025 to £25.3 billion, an increase of some 66% compared to 2015 to 2020. With over 50% of the company's revenue coming from the UK and over 20% from road infrastructure, this level of government investment is important. Smith Holdings has grown through the years through acquisitions. In the past 3 years, it has acquired some 14 companies. Due to this amount of acquisitions, the net debt at the end of October 2018 was £152.6 million, which is around 1.5 times earnings before interest, tax, depreciation and amortisation. The objective is to maintain this ratio at between 1.5 and 2 times. The company also has a pension deficit in the UK, France and the USA of £23.2 million. With a history of stable profit margins, a secure dividend and products which must pass through tough regulatory standards offering a barrier to entry from competition, Smith Holdings remains a good business for long-term investors. After a sharp fall in share price following the half-year results, it has recovered slightly and the PER is now at 17, which compares to the FTSE 250 average of 16.4. Smith pays a dividend yield of 2.68% compared to the FTSE 250 average of 3.14% and is covered 2.21 times by earnings. For these reasons, I have given Smith an overall rating of 2.8 out of 5. Thank you for watching. Please leave comments below. And also like and subscribe for further analysis of UK company businesses.